And the reason that I wanted to do this today, first of all, the VIX futures in general, it's just very important for volatility traders to understand how it all works, the expiration cycles, and how those futures directly impact the volatility ETPs that we all trade, the VXX, the UVXY, all the usual suspects. And this is the VIX futures term structure that we are all familiar with. So we've got, this is VIXCentral.com, by the way. Everybody can check this every day. It's got a lot of useful data here. And what we're looking at, this is called the VIX futures term structure. Now, each one of these dots that you can see on this line represents a different month in the VIX futures. So this one here, this is the front month future. I call it M1. So M1, M2, M3. You might hear it called VX1. It's the same thing. It's the front month VIX future contract. And you can see this one is the expiry for the February cycle. This one is March. This is the M2. And then April, May, June, all the way out. Now, the VIX futures term structure is something that is often referenced. And what people are essentially looking at here is they've probably heard somewhere at some point that the volatility ETPs are basing their pricing on these futures. So I wanted to first go over what the futures actually do, what expiration means, and then, of course, I will get into a more detailed analysis of how you actually use them correctly, because there's a lot of misinformation, or at least missing information, maybe not misinformation, but there's a very important aspect of this term structure that very few people talk about, and that's what I'm going to show today. So hopefully at the end of this presentation, you will get a much better understanding of what you're actually supposed to be looking at. So what we are looking at here, like I said, all these futures are for a different month. Now, the reason that I chose today, if I'm hovering over this future, you can see that it says it expires in 0 days. Essentially, that means it's expiring today. And then tomorrow, what's end up happening, this front future will be gone. It will be expired. And tomorrow, this back month future will now be considered the front month M1. So right now, just for one more day, we would call this M2 and this one M3. And then tomorrow, you'll wake up in the morning, this one will be gone, and this will be M1, expiring in March, and this M2 will now be the April expiration. So that's how the cycle works. You can see this green line here. This is the VIX index. Now, the way that these VIX futures work is that only for one day on expiration, at that exact moment that the VIX futures expire, the front month VIX future M1 and this cash VIX index, the spot VIX price, these are exactly the same. So all of these futures converge towards the spot VIX. At expiration, the front month touches and M1 equals VIX, and then it expires. And tomorrow, when you look at this curve, which I would encourage you all to do, you will see that there is quite a significant gap between the front month M1. Remember, this M2 will now be M1 tomorrow. There will be a significant gap here. And that's essentially what people are talking about when they're referring to roll yield, or how the volatility ETPs might potentially, get their pricing, right? It's not based on supply and demand. It's based on these actual futures. So that's the important part. Now, these numbers down here, typically, because we're trading VXX, UVXY, these are all front month contracts. They're volatility ETPs that track the front month of the VIX futures curve term structure. So this first number, this is what we call Contango. I'm sure you've heard of this in many places. We'll just do a quick calculation just so you can see how this is actually calculated. You may hear people say Contango's 10%, 15%, but you might not be actually aware of how easy it is to calculate that. So if we look at the second month M2, currently, 25.75, front month 21.48. So we can just do 25.75 minus 21.48. Hopefully this doesn't change. So there's $4.27 difference there. And then we just want to know how far above the front month future it is. So 21.48. And that is how we arrive at the 19.87, which is right there. That is the front month Contango. What I want to show is where that 19.88% ranks as far as history. And then we will circle back to what happens when the M1 disappears. So if we look at a little bit of data here, this is one of my spreadsheets, we can see that the current value, this was an intraday value, so it's slightly different now, but that 19.51% Contango in the M1, M2 VIX futures is extremely high. It's actually in the 99th percentile. So if we look at a chart of this M1, M2 VIX futures Contango going all the way back to the launch of VIX futures in 2004, we can see that that red line is the long-term median at 6.25. That is the long-term average marked in the red line. The green line is where we're at right now, 19.51%, basically 20% Contango. It very rarely gets this high, right? Again, 99th percentile. So people might be thinking to themselves, well, you probably are aware that the higher the Contango level, the more those futures could potentially drift down towards the spot VIX, right? This is the potential in the short volatility trade. Now, nothing is guaranteed. It's very important to understand that just because there's Contango right now doesn't mean that the market can't do whatever it's going to do. It's obviously a freely traded market, and regardless of 20% Contango, we could wake up tomorrow and the VIX index could be spiking 30%, and short vol traders could have a really bad day. So it's only ever potential. But with 20% Contango, which it almost never gets to these levels, people might be under the impression that this is one of the very best times in history to be short vol, right? And it's not entirely wrong. I mean, we do see Contango, but it is important to actually have the correct data. So that 20% is actually not exactly the right number that you want to be focusing on. Because again, like I said, tomorrow, this M1 will be gone, right? This will be off the board, and now this is M1 and this is M2. The difference between these two futures starting tomorrow is what the new Contango number will be. And down here, you can see it. I'm not going to go through the calculation, but you can do the same thing. How far above this future this one is, that's what Contango is. You can see it's only 9.41. Now, that's not terrible. Let me refresh this just so it shows up. That's still above the long-term median, right? So the 9.9, if the market opens exactly where it is, that'll be somewhere about there, right? That'll be the new Contango level tomorrow. It's still above the long-term median, but it's nowhere near one of those record-breaking sort of, nearly never touches it type of level. So that is actually quite important for all of us who are trading volatility, because does that make any sense? If you're trading volatility products and you're holding short volatility on Tuesday, near record-setting levels of Contango, the highest ever was 33%, but like I said, it almost never gets above 20. But tomorrow, just the passage of one day, Contango will drop back to single digits tomorrow. Does that make sense? Does it make sense that our short volatility trade will now suddenly be worse tomorrow than it is today? Let's assume that the market is exactly the same tomorrow as it is today. The S&P 500 opens flat, the VIX opens flat. It's more or less tomorrow is mirroring today. Does it make sense that now our trade has fundamentally changed to that extreme level? Well, no, and that's what we're going to be talking about right now. So that's the first sort of headline number that you might get deceived into thinking if you follow people on social media, for example. They'll just quote, wow, we have insane, massive Contango, awesome time to be short vol right now. What they're not factoring in is that these volatility ETPs actually track an underlying index with a set methodology. And this is that index. So I've shown this before. Let me just refresh it. I've noticed sometimes it doesn't show if I don't close and open it. So apologies for that. But this underlying index is what the ETFs are actually tracking. So I've got a little picture here. The blue line is that SPVIX STR index. That is the underlying index for all of the front 2-month volatility ETPs. Your VXX, UVXY, VIXY, SVXY, anything that's the front 2-month contracts, this is what it's going to be tracking. Of course, at different leverage factors, and SVXY is an inverse to that blue line, but this is what they're all based on. So you can see the red, the VXX, is essentially the SPVIX STR index. Again, I hope this is showing up. And then the yellow line is the UVXY. It is an exact mirror on a day-to-day basis. The only difference is, of course, it's a 1.5 times leverage factor for the UVXY. So it starts at a much higher place. It decays to a much lower value. But relatively speaking, on a day-to-day basis, the VXX is 1 times the underlying index. UVXY is 1.5 times. And the way this works, this is the important part, is that the methodology of this thing is that it actually calculates the changing values of what they call the constant 1-month rolling position. Now, the way that this is calculated, if we look at these front 2-month futures, back to VIX Central again, what we see is that this front month will be gone. And this second month is basically the new M1. So we can tell based on the combination of these two what the actual future is tracking, right? What is this index actually tracking? Because it's certainly not using very much of the front month. That one's going to be gone. You can get the exact value of how much it's tracking of each one of these futures by just going to the iPath website. You can go to ipathetn.com. Over here, you could just type in VXX, and this page will come up. If we go into the index components, you can see that the February future, it only has a weighting of 5.26%. And the back month March is basically 95%. Okay? So if you track how much of each it's holding with the underlying methodology, then you can get what is basically considered this rolling constant 1-month maturity contract. So right now on this VIX Central curve, that would basically be right here. It's holding 95% of M2 and only 5% of M1. And of course, I calculate this for the VTS community every single day. So if we go to the beginning, you can see here the daily roll, it's the same 5.26%, right? Now, next month will be different because there's a different number of days in each expiration cycle. And if there's a holiday, of course, you have to back out the holidays as well. But you can calculate in equal increments what this VX30, this is what I call it, the VX30, the constant maturity future actually is. And it's actually right about here. It's nearly all of the M2 right now. So when this front month M1 actually disappears, it doesn't do anything to the actual underlying volatility ETPs. It doesn't do anything to this. This index is still tracking that rolling, always updated 1-month maturity contract. So if you are the type of person that is trading based on the Contango level, well, you're going to be seriously deceived into thinking that right now is one of the highest levels it's ever been. When in actual fact, the underlying SPVIX STR index, which the VXX tracks, the UVXY tracks, it is above average. That VX30 is definitely above average, but it's not exactly as high as you might think. So this is my daily email from just today. Of course, these are using intraday values. But in our volatility dashboard, you can see, this is the general metrics. There's that M1, M2 VIX futures, 1951, 99th percentile. So clearly, all out green light short vol. It's the best time, one of the best times in history to be short vol. But of course, the M1 is expiring and these numbers are completely going to be changing tomorrow. So what I also do, this adjusted M1, M2 VIX futures is really what we're looking at. This is taking into account all of the differences in the decay factor and the expiration cycles, the number of days and all the weighting of each of them. That's what that number is taking into account. So when we look at the adjusted M1, M2 VIX futures, there it is. It's actually down to about 9.2. Now that was intraday. It's a little bit different now, 9.61, but that is essentially what we are talking about. So there is actually quite a significant difference there between the headline number, which would be the Contango level, right? A lot of people just say, wow, M1, M2 Contango's at 20%. That doesn't mean anything because, of course, every day, those underlying products are holding a different composition of those VIX futures. So as of right now, 95% of it is the M2 future. When the M1 disappears, who cares? It doesn't really do anything to the underlying. We're not going to see some radical difference tomorrow with the decay factor than we don't see today. The VXX at 20% Contango is not going to suddenly stop decaying as much when it goes to 8 or 9 tomorrow. That's just how the futures work and the expiration cycles. So it's very, very important that you actually study those futures, understand what they are. And if you're very detail oriented and very analytical, you might want to actually go and try to calculate them yourself. Like I said, I calculate all these things. I track a whole bunch of data every day. And that's what I share with my VTS community, right? I calculate these numbers. We also have the VX30 constant maturity. It's actually at 25.69 when I sent the email. This is the VIX futures, 25.72. The VX30 is essentially right there, right? And that's what I show people. So the The way that the volatility ETPs will decay, and this is important for you if you're a short vol trader, is the difference between these futures and the VIX index is really what you're trying to quantify. And it's very useful to know that it's not actually measuring this one. It's measuring something that's right there, basically 1 day away from expiration and this one completely disappearing. So when you log in, that's why today I like to do the live stream. It was the perfect day to do it, because when you log in tomorrow, this 20% front month contango will actually be probably, if the markets open the same place they are now, no guarantees of course, but you might see that M1, M2 contango dip into single digits again. And now that you sort of know what's going on, you know why that's happening, you understand that it's only because of the passage of 1 day on the methodology of those VIX futures. You understand that it's insignificant as far as us trading goes. It's not like I'm currently short vol in all of my volatility strategies. I've been short vol for a while. I'm long the stock market. I'm certainly not going to exit positions because now the contango level is going to be seriously lower. It's not going to do anything to me because that VX30 contract that we can all calculate, that is really what we're trying to measure. So that's what I said, a little bit of homework for this thing. You check the VIX futures now, look at the shape of this curve, check the contango, look at the numbers, and then tomorrow, it's actually going to be a completely different number. If you have a spreadsheet, you can then go in tomorrow and you can basically, I don't know how many days, let's say it starts at 19 again. Sometimes it starts at 24. Different numbers, you'll calculate, you'll add it up, and it'll be a different daily decay factor. But it's always incremental, same equal increments every single day. It's holding slightly less of the M1 and slightly more of the M2. And as time goes by, we move towards expiration. Happens on this day. The next day, the cycle starts over again. So if you're interested in seeing more detail about this, I've actually done several videos on this subject. If you go to the YouTube channel, what you can actually do, this is just the front page of the channel. If you go to this search bar, you can type in VIX futures, and you can see, this is today's live stream. We're live right now. But I've done several videos that talk directly about these VIX futures, the roll yield, how these can be used as stock market indicators, all of these things. The VIX futures is actually fairly important for us volatility traders. Certainly not the end all be all. It's not like if you understand the VIX futures term structure that you're suddenly going to, be a millionaire trader. It's just an entry level thing, of course. There's many, many more levels. We can go way further down the volatility rabbit hole. But it is a very good start. And if you don't understand that term structure or what I was talking about today, the SPVIX STR index and the way that it has the 1 month rolling future, if all of these things are somewhat foreign to you, that's fine. Everybody starts at the same place. But you might want to tone down your volatility trading until these things are second nature to you, until you understand it intuitively and all of these things are not going to catch you by surprise, because you certainly don't want to be trading short vol based on a very simplistic and, to be honest, just incorrect assessment of just looking at that front month M1, M2 contango number and using that number. That number changes constantly based on how many days to expiration there are. And of course, I want everybody who's following my work to always have the correct data and always understand how things change dynamically, because nothing is a snapshot in time, right? The VIX futures is a constantly changing market. And so that's how it works. Kind of interesting. And today, of course, being the last day till expiration, this is the big day to really hone in on that process and understand how it all works. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.